Typical accounting practices involve two methods of recording revenue and expenses. The first method is the cash basis of accounting. Here, revenue are recorded when cash is received by the business, and expenses are recorded when cash is paid. The accrual basis of accounting, on the other hand, records revenue only when they are earned, and expenses when they are only incurred. Under the accrual basis of accounting, adjusting entries are made in order to ensure that the entity's revenue and expenses are properly recorded in adherence to the matching and revenue recognition principle. Because of the misalignment in timing, cash is never affected in adjusting journal entries. There are four scenarios that illustrate the necessity of adjusting entries. The first is known as deferred revenue. This occurs when cash is received before the firm's revenue has been earned. Suppose Carlingford Swimming Academy has prepaid $5,000 on the 1st of October for 10 swimming lessons to be completed in November. Since the academy has not yet provided the service, the $5,000 that the firm has been paid for cannot be recorded as a revenue, but is rather recorded as a liability. For the month October, Carlingford Swimming Academy would record on the 1st of October debit cash, credit unearned revenue. Then once the academy has completed the lessons, the adjusted journal entry for the month ending December will be adjusted, debiting unearned revenue and crediting service revenue. The next scenario illustrates adjusting entries is that an accrued revenue. This is simply when cash is received by the entity after the revenue has been earned. Suppose that a detective Sherlock Holmes investigates a case on 15th of June for $6,000 of fee and receives payment on the 3rd of June. Thus, Sherlock would record his $6,000 of revenue at the end of the month by debiting accounts receivable and crediting service revenue. He will adjust his entry at the end of the next period after the payment has been received by debiting cash and crediting account receivable. A deferred expense is when cash is paid before the expense is incurred. The most common example of this is prepaid insurance. Suppose Wayne Enterprise prepays 12 months of insurance in May for $12,000. The journal will record in January debit prepaid insurance, credit cash in June. After 1 month's insurance has been paid, it will debit insurance expense of $1,000 and credit prepaid insurance. The final scenario involves accrued expense where cash is paid after the expense incurred. Consider a factory that incurred $500 of electricity expense for the month of August, but does not pay this bill until October. The journal would record debit water expense, credit accounts payable. Then after the bill is being paid, it would debit accounts payable and credit cash.